Advanced Financial Accounting. In this presentation, we're going to work a practice problem related to a consolidation process between two companies, a parent and subsidiary type of relationship. We're going to record this consolidation where we have a cost method. In other words, the parent is holding the investment in the subsidiary on their books at a cost method, which is going to affect the eliminating entries we're going to have to enter into our consolidation worksheet. Note, we will be stepping up the level of complexity as we think about different types of consolidations. In this consolidation, we're going to say we have P, the parent company, purchased 100% of S, which is going to be the subsidiary's shares, at the beginning of the current year. So we have a whole year that took place. It happened at the beginning of the year. 100% was purchased, not something just controlling over 51%, but 100% for the net asset price. And then the thing that's going to be different here than in prior presentations is that as opposed to what you would kind of assume P would be recording the investment at, which would be the equity method, we're now going to assume that they're recording it at cost method. So P's basically saying, hey, look, I'm just going to record it at cost method here because maybe that's an easier thing to do, and we're going to have to record the consolidated financial statements. So now we have cost method. What's that going to look like with regards to our consolidation of the two financial statements? Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We're going to have the information on the left-hand side. We're going to be entering that information into the blue area on the right-hand side, both in terms of our consolidation journal entries or adjusting entries or our elimination entries, and then in terms of our worksheet over here on the right. Let's take a look at what our objective will be. P acquires 100% of S, so we're going to say P's one company, parent company, that's going to acquire 100% of the other company, S, which is going to be then the subsidiary company. So 100% of the shares, so not a controlling interest, not something just over 51%, 100% of the common stock. Now they purchased it for $307,000, and we're saying that the value of the book value was also $307,000 at the time of purchase. So those things are the same at the time of purchase. P decides to carry S investment at cost because the investment will be consolidated. So P says, hey, I'm not going to do the equity method. Why do I need to do the equity method when I could just carry it at cost? That'll be easier. And I'm going to do a consolidation worksheet at the end, so it's going to be reported together anyway. So let's just carry it at cost instead of using equity. That's what's different here. Purchase at the beginning of the year. So the purchase took place at the beginning of the year. Now it's the end of the year. It's been a full year, and we're going to be entering the adjustments at this time. All right, so then we have our consolidation worksheet. So basically we're going to say, hey, P and S, if we're the consolidation people, would you give us a trial balance as of the end of the year? So as of the end of the year, we're going to get the trial balance for P and S, basically their financial statements. The trial balance, we're going to combine them together. Now we've listed out the trial balance here in the format that we're used to, debits and credits in one column. I think that's going to be the easiest way for us to do the calculations by far. And so we have that information. And then also note, again, they're lining up very well because in this case, we have two sets of GLs that are very similar. So just remember, in practice, if you're taking two sets of books that weren't built together, then you're gonna have to do some tweaking to get them lined up nicely. In other words, again, the expense accounts and the account numbers and whatnot will not be the same. So it's going to take some kind of grouping. You're going to have grouping issues to group the proper accounts so that you can do the consolidation properly. As you go, you want to make that as easy as possible so that the two general ledger accounts are going to be reflective of each other, the chart of accounts and account numbers, so that when you do the consolidation process, it's an easy process. So here we've got that done, right? We're saying, okay, now these two companies have made their financial statements very similar in terms of their chart of accounts, which is nice. So then we can just line up their chart of accounts and their trial and these two trial balances and just basically total them up. And that'll give us our preliminary numbers. Then we got to think about the eliminating or consolidating entries. So we've got these two sets of numbers. Now we're going to sum them together. So we are in L3. I'm just going to say equals the sum of, we'll pick up these two numbers. There we go. And now we're just going to autofill that all the way down. So we'll put our cursor on the little autofill here. Auto will drive it down, and Dr. Phil will do the calculation when we let it go. And there we go. So there's the autofill. And then we have that. So now we're in balance. So we're in balance here. And that's basically our consolidation. But we're not done yet because, of course, we need to do the elimination entries. And again, just note that step, why was that step so easy? because we're saying that these two companies have very similar chart of accounts here, which we worked very hard to do because otherwise you'll have to do the grouping thing. Okay, so now we're going to have to do some elimination. So we're going to say, okay, what needs to be eliminated in our elimination journal entries to get our consolidated trial balance, which we can then use to create our financial statements? Well, we have the investment here. That's going to have to be eliminated, and we have the investment's going to have to be eliminated, and the other side of the investment is going to be the common stock here. And then we also have the income, dividend income. Now, if that dividend income is coming from the other company, in this case, S paid dividends, all of them, to P, there's that relationship. So we're going to have to deal with that. Now, this is a little bit different than a prior problem because P is recording the investment here, not using the equity method. If they were using the equity method and we acquired 100% of the stock, and at the point of purchase, the stock equaled the net value, which we saw in a prior problem, which is an ideal situation, not always the case, but if that were the situation, you would think that at this point in time, the investment, if this were the equity method, would be equivalent to assets minus the liabilities or to total equity, which is what we saw in the prior example when we were using the equity method under similar conditions. So 332, that's not the case here. Why isn't it the case? Because P decided not to use the equity method and just use the cost method, which is okay considering that you're going to have to consolidate anyways. So P's just saying, hey, cost method is easier. I'm just going to do that and not deal with this equity business and just do that. So what they did then is they put the investment on the books at cost. So this is the journal entry that happened when you had the consolidation at the beginning of the year. They put it on the books at cost, debiting the $307,000, crediting cash, and then they're just simply going to record the dividends. So then the dividends were given that were issued. Dividends issued, they record the cash increase in the dividends that were given to P from S, and then they just simply recorded the dividend income. This should be dividend income, not just dividends. Let's say dividend income here. So that's all they have here. Now, note what they didn't do also is this is similar to like a market value method, but they didn't tie it to the market value either. They didn't try to tie this into the broker statement. So this is kind of like the method that you would typically use when you have less than the 20% and don't have influence, except that in that situation, you would typically then at the end of the year adjust your books to the market value. But they didn't do that. We're not going to do that here because at the end of the year, they're going to consolidate. So they're just saying, look, it's at cost. I'm not going to tie it to the market. I'm just going to put it on the books at cost. I'm not going to use the equity method. I'm just going to put it on the books at cost. And then you can check out the consolidation worksheet to see how the thing is put together in terms of a consolidation. So mull that over as you're thinking of these elimination entries, because that'll affect the way the elimination entries will look. Okay, so if we go through this, the first thing I'm going to say is I'm going to go, okay, the investment in S, that's got to go. That's got to go because we can't have an investment in S when we're reporting the consolidation books where we are kind of S. So this number needs to go to 0 for sure. So I'm going to say, all right, well, I know that's going to happen. Once again, I'm going to be constructing the journal entry not in terms of debits on top. You can go back in and make it look pretty with the debits on top afterwards if you want to. I wouldn't even do that if you don't have to, because I want to construct it in a way where I can go back to it in 3 years and understand it best, not to have it look the prettiest. So I'm going to say then that we're going to pick up this investment in S, and then this is, I'm going to say credit. So I'm going to put this on the credit side, and we'll pick up the 307. So that's going to be removing that 307. So I know I need to do that. Now the other side of this, notice that we put that investment on the books at cost. So that's and then we just kept it there. We're not changing it at all into the market value or we're not going to be changing it with regards to our portion, the 100% of the income as we would with the equity method. And we're not even changing it to the market value as we would if we were using, a method that we would typically use that would be below the 20%. We're just carrying it at cost. So then we just got to think about, well, what did we purchase it for? And you'll remember in the problem, we said we purchased it for the book value as of the date of acquisition, and we purchased 100% of it. So given that, again, in practice, we would know what that is because we would know what the purchase time was. But here you could say, okay, we purchased it at the beginning of the year, and if we purchased it at the beginning of the year and we purchased it for the book value, assets minus the liabilities as of the beginning of the year, that should tie out to the equity method at that time. And that would be the common stock and the retained earnings. Now, you might say, well, this is the common stock and the retained earnings as of the end of the year, which they are for a trial balance. But notice that the revenue and the dividends haven't rolled into it yet. So these numbers basically represent, if there's no activity in them yet, they represent, which there shouldn't be because nothing was posted to them as, since we closed out prior year. These are the beginning numbers. These are the original investments. So if I was to highlight those two, there's the 307,000. So the 307,000 equaling the initial investment, equaling our initial transaction, the initial cost that we paid for, P paid S for this transaction. So that's going to be the other side then. I'm going to say, all right, then we need to remove the equity section. We're going to say, all right, there's the common stock then. And it needs to go down. This 206, the S's portion needs to go down. It's got a credit balance, so we're going to debit it by that 206. So we'll debit that by the 206. And then we have the other side being retained earnings. So there's the retained earnings. And once again, that's a credit over here. So we're going to do the opposite thing to it, which will be a debit. So we're going to debit that. Now note that just to simplify things a bit, we broke out the dividends, which you might see as being posted just simply to retained earnings in practice. So we broke out the dividends into another account, representing the amount that was paid out to stockholders. In the case of S, the amount of dividends that were paid out of retained earnings, typically to P. So if we hadn't broke out dividends, you'd have to look in retained earnings, the activity, and see if there were any dividends paid. And these two accounts would be represented then at net at the 75,000. Okay, so then these two tie out. That's going to be our transaction there. That's our elimination process there. So that should be good on that. The other thing we have to say is okay, were there dividends issued by S? If they were, they all went to P, and that's an intercompany transaction. We could say, and again, if we hadn't broken out the dividends from retained earnings, we would have to look at retained earnings to see the dividends. But here we broke them out, as we might see in like a sole proprietor kind of breakout, where the dividends often are broken out separately so we can see them. And so there they are, and we're going to say, all right, there it is. And what did P do when we broke out those dividends? Well, they just said, okay, well, P just said, I got cash, came into P's books, and then the other side is going to be going to the dividend income, which is right there. So we just need to eliminate these two transactions. So we're going to say, all right, let's just get rid of that. And that shouldn't be a problem. So I'm going to say then that let's pick up the revenue first. So because this is going to be a debit, I'll pick up the dividend income. So here's a credit. I need to debit it to remove that. We don't need that. We can't have it. Not just that we don't need it, we don't want it. We can't have it. It's wrong. It's wrong. And then the other side is going to be going to the dividends here. So there's the dividends, and then we'll remove that. All right, so that should get rid of this, and it should get rid of that. Let's check it out. Let's see what happens. So we're going to say then, if we post this, we're going to post the investment in S. So here's the investment in S. We're going to be posting this to our consolidation entries or eliminating entries. I'm in M6, cell M6. I'm going to say equals, scroll on over to that 307, enter. That brings it down to 0. So that's good. That's what we want. Then we're going to go to the common stock. So we're going to go on down to the common stock. There's the 206. We're going to be here in cell M12, where we will say equals and scroll on up to that 206. So there's the 206, enter. And then, so we had common stock for P, common stock for S. S's portion has basically been eliminated. Here's the total. And then we took it back down. And there it is, basically matching what it was originally for P here. And then we have the retained earnings. Retained earnings, here's retained earnings. We're going to be in M. So M13 equals, we'll scroll on up to that retained earnings at the 101. Same kind of scenario. We had the retained earnings for P. There's the retained earnings from S. There's the total. We then remove the retained earnings for S, the beginning retained earnings amount, because the net income hasn't closed out into it yet, or the dividends. And there's the amount that's remaining that's the same as what was on P's retained earnings. All right, and then we're back in balance, so that looks good. First journal entry posted, good to go. Then the second journal entry, dividend income needs to go away. All right, dividend income is down here, so here's dividend income. So I'm going to post that. I'm going to say this equals, and go on up to that dividend income, 26, and that should make it go away completely, so that's good. And then the other side of that is the dividends. So the dividends that were paid from P to S needs to be eliminated. That 26,000 needs to be eliminated. We're in cell M14 where we will say equals, scroll on over to that 26,000, removing those dividends, leaving us once again with what was in P's book. So here's P, there's S, there's the total of them. We removed S's portion of dividends because they got paid to P, and then there's the 102, which is what was on P's books originally. That'll put us back in balance once again, and we only have to worry about that funny depreciation thing at this point now. So as with similar problems, we're basically going to record the depreciation at book value at the point of the consolidation here, and then depreciate from that point forward. That means that we need to know what the accumulated depreciation was at the point that we consolidated. In this particular special situation, since it's only been 1 year, we can see then that we have the accumulated depreciation at 30,000 and depreciation expense at 15,000. So the difference between those two must then be the depreciation in the current time period or it must be what the depreciation was as of the beginning of the year, which is when we consolidated. So I'm going to record the transaction and then explain it because I think it's a little bit easier to do that. So I'm going to say this is going to be the accumulated depreciation. We're going to debit. The amount is going to be, I'm going to say, equal negative of this number and plus this number. That's where the calculation is coming from. And then that's the 15,000. Debit and credit will be the same. And then the other side is going to go into the building and machinery. What's that going to look like when we post it? Accumulated depreciation here. If I go into M9 and say equals, we're going to be picking up that accumulated depreciation, ACC depre, and then the book value. I'll pick up the book value, which is a credit. I'm sorry, the book value, the building and the machinery, the property, plant, and equipment. So the property, plant, and equipment went down by the amount that was in accumulated depreciation as of the point in time that the purchase took place, which was the beginning of the year, which we can back into and figure out given the fact that at the end of the year, we had accumulated depreciation of the 30,000. Only 15,000 of it was recorded in the current year. Therefore, the difference between the two must be the accumulated depreciation that was on the books as of the beginning of the year. And what we want to do then is record the building and machinery for S as a book value total in building and machinery as of that point in time, and then depreciate it going forward. So that's kind of like the gist of that journal entry, why we're doing that. So in essence, there we have it. So same kind of consolidation process, but looks a little bit different given the fact that P is carrying this information at cost now, carrying the investment in S at cost rather than at the equity method. But note that the ending result here, right? Assets minus liabilities, 1,215,000 equals the equity down here, which is going to be the 1,215,000, and we've eliminated those intercompany transactions, the dividends going from the S to P, as well as the investment in S, because now we're basically together now in this place, and then the equity section transactions related to them.